All righty. Hey, good morning, everyone. It is the Hurley Investments Podcast. With me today, I have a new member of the team. We've got Keeve Bybee. Keeve, go ahead and say hi.
Hello.
Keeve is the newest member of Hurley Investments. That's his picture down below. You can see him. I'm that ugly guy up above. And today we're excited to go over what's happening in today's market, being February the 17th, Options Expiration Friday. So let's jump into this as quickly as we can. We had some pretty unique economic reports come out this week. Keeve, I'm going to let you go ahead and start. People want to hear you. You're the new guy. Fire away. What did you see that was interesting to you this week in our economic reports?
Well, a couple of conflicting things. We have retail sales up, which is interesting for January. Usually it's down for January. Everybody's buying stuff for Christmas and then not buying things after. So that's kind of interesting. We also have inflation, CPI and CPI going up. So considering that with retail sales, that's kind of a conflicting thing. Normally when inflation goes up, things start to cost more. Retail does worse because our dollar isn't buying as much. So that's kind of interesting. Don't know exactly what to think of that, other than maybe one of those reports is a little behind, or one of them is wrong. So that's kind of interesting.
Agreed. In fact, when you get those conflicting reports, you wonder which one's going to be right. You typically don't have inflation going up where things cost more money, yet higher retail sales, especially higher retail sales after a big event like Christmas. I like you, I found that very interesting. I really scratched my head. If we go through a couple more, regional manufacturing was up better than expected for the Empire there in New York. If you go down to the Philly Fed there in Philadelphia, ridiculously high, better than expected manufacturing numbers. But then you signed industrial production again, that was a negative 0.3. Uh, the short answer comes down to this. We have some conflicting reports right after Christmas, but what might matter the most is we have housing back on track, both for residential housing and housing starts, building permits, so you have uh, bigger business construction or commercial construction going on, and that was followed up by leading indicators that was a little bit higher. Pretty confusing economic week, and we're going to have to see how things shake out. It'll be interesting to see how we move forward. In fact, talking about moving forward, we're in a Trump market. I think maybe some of these economic reports are somewhat misunderstood because we have a huge amount of euphoria in our markets. We're hoping for these big changes. I really like the picture, the snapshot there. Trump is giving investors the playbook: get on board or get run over. And I don't know if you can find a better way to describe our market right now. It's interesting though. I watched Stockman, and we have a little comment there. Trump, completely insanity, and the markets are in fantasy land by Stockman. That article came last Sunday, and I was watching it Sunday morning, just realizing from economists that I value highly, Stockman, none of the numbers add up right now. None of the numbers add up for growth for the S&P, for earnings growth for the S&P. In fact, if you do just a historical chart, we have a couple divergences that are very unsettling. One of them obviously is the Case-Shiller. The Case-Shiller right now shows levels that were met in 2000, 2008, and 1987 for the big drops there. Stockman made a play on TV and said, hey, we're going to have to pay the piper eventually, and I hope markets are going to be ready for it. On the bottom right, we talk about Trump lifts the S&P to record market caps. Again, unbelievable. In fact, it's unsustainable to have a 20 trillion market cap when we have anywhere between 9 to 13 trillion that was invested through quantitative easing, mortgage-backed securities, and so forth, and or government buying of stocks. When you back out those numbers, it really makes you scratch your head. I did put a little iPhone article in there. Obviously I love Apple. I buy a lot of Apple. I'm excited for their new phone. One of my friends says, "Yeah, I'm going to wait till September," and I kind of chuckled and said, "Well, I'm going to get an iPhone 7, but I've got to add another kid to the plan eventually." So he'll take my iPhone 7. I'm still going to be greedy and get the new iPhone as it comes out. The whole reason why we're trying to say this is right now markets don't make sense. You can't prove market market valuations. You can't prove any models going forward. Everything is out of whack, and the risk is obviously to the downside. Now, if we were other investors, we just put you into cash, but we don't want to miss the upside, so we do have you in positions that can be protected as markets fall down, or that are currently protected through earnings. But understand the market again is going through a phase that has never been gone through before. It's a first time for the market. It's a first time that we've had such stretches in earnings versus the S&P. There's a lot of unique things. In fact, doesn't mean that when the markets get out of whack that we're still not doing our homework. I think we're going to bring up our next slide, which is Visa. Actually, it's the S&P 500. In fact, Keith, taking a look at this chart, any comments you have on the chart for the S&P 500 that you'd like to make to the group here?
Well, just that we're still sitting at all-time highs, and we're quite a bit overbought. Maybe coming back the last couple of days, you can see why. And yeah, but we're still bullish, so it's kind of interesting.
Still bullish. In fact, last time it pulled back there in December, you can see we went sideways for 6 weeks, almost 7 to 8 weeks to consolidate. Wouldn't surprise me if we waited 7 or 8 weeks to consolidate, and maybe we'd consolidate for a new tax system that Trump says is coming out in the next 2 to 3 weeks. Maybe that creates a consolidation there. I do see a couple things that do worry me, though. Look at how far stretched our 50-day simple moving average, which is that blue line, is above the 200-day. The 200-day sits at 2173. The 50-day sits at 2278. We have a 5% stretch roughly there on the 50-day and the 200. Historically, that sits somewhere between about 2.5 and 3. So we have literally a 2% drop in some consolidation to bring that chart pattern to a more historical norm. Not to mention from the 50-day at 2278 up to the 2342, little stretch there, but more importantly, 2342 all the way down to the 200-day at 2173, we've got almost a 10% gap or stretch there. And historically, that sits closer to about 4.5 to 5. So rather unique. Obviously, the S&P, the key thing that Keith mentioned, we are overbought, but at all-time highs, which means there is no cap to the upside right now. So with that said, let's move over to Visa. Keith, talk to us about Visa a little bit. I think this is the one that you're invested in. What do you see? What numbers have you crunched? What comments do you want to make about Visa?
Yeah, so Visa, there's a lot of things to like. Just looking at the chart, you can see coming off of earnings, it's come up quite a bit. You can see that big jump in that gap from 81.42 up above 85, and following those few days after kind of established a pretty good level of support at 85, and then went up rather quickly. Became a little overbought, as you can see up at the RSI. So might come back down a couple dollars, but still bullish stock, and yeah, a lot of potential for more growth though. Um, you can see from our valuation, we take a forward PE. You look at we just have a snapshot of FinViz on Visa. Two columns over, two rows down, we have our forward PE of 22.56. We multiply that by the next year earnings per share, which is just the column over, same row, second down at 388. That puts our valuation at $87.53. So, which is just about where it's trading right now. So you look at that and think, well, if it's at full valuation, why would we want to stay in this? Why wouldn't we want to say, all right, let's take our run up and let's pare this back? But something that wasn't in that valuation is the potential for growth back over in Europe. A while ago, Visa had sold their Europe arm. They'd sold it for about $9 billion and bought it back recently for $16 billion. So really just paid around $7 billion to get it back. That, if you were going to bet that they could manage Visa a little better in Europe, you could make a pretty good bet there. So there's some opportunity for Europe and Visa to expand globally. That's nice, because we like to see that they're diversified as far as not so tied so much to things going on domestically. But it's nice to see that compared to some of the other companies there, American Express, your Discover, MasterCard, they can't say the same thing. They're pretty tied domestically to things, and so that's nice to see Visa in comparison to some of their competitors. Kind of looking at a few other things I like about Visa, kind of from a bird's eye view, is their credit usually does pretty good during economic downturns. People are buying more stuff on credit. That's nice. We're expecting interest to go up, interest rates, and the way that Yellen is talking recently, it might be wise to assume that it's sooner rather than later. We're thinking that it would be maybe an interest rate a year for the next few years at the end of the year, but the way she's talking is suggesting that maybe that might be closer to something like March. Really, all that we're looking at there with regard to Visa is just that interest rates go up. Obviously, your credit card companies can do much better charging higher interest. So just a good thing for Visa. Another check in a box that of one of the many things we like. So that's kind of what I'm looking at, why I like Visa.
Good points. In fact, I remember when Keith came and pointed Visa out to me, he said, in all honesty, it's like they bought back their company and let someone else lay all the groundwork for getting Visa stations set up across Europe. I kind of chuckled and I thought, that's a very unique way to look at it, but as he showed me the numbers and worked through it, I had to agree. I'm also in Visa. I like it. I think it has some great opportunity. Keith, good research there. If I can do a little bit of
Thank you.
research as well, let me go to Baidu. Baidu is my recession-proof stock like Visa. As Keith said, when people here in the United States uh, don't have the buying power with their money, we're going into recession. We live off of our credit cards. Um, I have also noticed that when the U.S. isn't doing so good, a contrarian play has typically been China. China starts to do better. China's the second largest economy in the world. It's trying to take over us being the largest economy, and I've just noticed that, hey, when U.S. stocks are going down, Chinese stocks are going up. So we have Baidu, which is the Chinese Google. It has been consolidating. It is in a bullish pattern, just slightly overbought or touching the overbought line. That typically has happened when it comes to earnings. And Baidu is one that will stay. You can see Baidu overbought for a while. It has no problem staying overbought. With that said, I ran my valuation numbers doing exactly the same thing that Keeve does. We take that forward PE, which sits at 32.38. You'll find that in the second column over from the left. Go 2 columns to the right, second one down, forward PE. You multiply that by the estimated earnings per share for the next year. That is in the third column from the left, second one down at $5.71. As you run those two numbers together, you see that Baidu would be at a full valued price of 184.88, which is roughly where it's trading at today. We've been in Baidu for over a year, and as it was down that 140s, 150 range, a lot of people ask, well, Kevin, why are you still in Baidu? We should have gotten out of it. We should have dumped it, something like that. I wish I could tell you that I'm perfect in market timing and I can just see into the future and outguess what's going to happen, but I can't. What I did know, though, is these same valuation numbers, when it was trading at 150, 140, they still held true. It said it should be closer to that 188 range. Hence, we stayed in it. Hence, we are protected for earnings on Baidu coming up next Thursday. And we'll see if we can't see Baidu jump up, as you saw that chart earlier, back up to at least 200 for the yearly high or 235 for the all-time highs. A couple comments I'm going to make. You'll notice as we have had some protection on in your accounts, we have not capped you to the upside. You haven't seen a whole lot of short calls being placed right now. And unfortunately, a couple of the stocks that we have in maybe have gone down in this last run up in our stock market. It may have been a retail, it may have been, the old Smith & Wesson company. There are a couple out there that are not moving exactly the way we've had planned. But you may have noticed we haven't capped it to the upside. We haven't taken in a bunch of credit on a short position that's going to allow us to, still sell our stock off at a profit, but at the same time it does cap upward growth. The reason why you haven't seen that other portion of this call or trade or that protection is because when your markets do start to run higher, you typically don't want to be capped to the upside. That's not helpful for you. You're not going to be sitting in a good position if we have your upside capped in a bullish running market. You will definitely see us cap more of the upside and take more of that credit in when the market is bearish, when it's going down. But if we're moving upward in our stock markets, you will not see us necessarily have you capped to the upside very often. We want that growth. We want to let the winners run. We want to protect ourselves on the downside for the losers that don't go the way that we have planned. With all of that said, some things to look up to that are some good or bad issues. I guess it depends how the market's going to take it. If you took a look, we have a rate hike most likely going to occur in March. We have the inflation and the growth that, as Yellen said, hey, expect a rate hike in the near future. It's going to come. We should be ready for it. And I shouldn't be saying but it's It's an uncertainty, but definitely for this year, expect more rate hikes into the future. She said she wanted to do 4 this year or last year. It never happened. So expect her maybe to catch up this year and get us back this year for those rate hikes. You would expect this year a border tax or a tariff tax. Expect Trump to make sure that he keeps it here in the U.S. Expect that he would say to us and hold himself accountable to the fact that he wants growth in the U.S. You see it on the left as isolationism, where he's isolating us from the world. But in all reality, I don't quite see that. Obviously, I don't know what the guy thinks all the time because he is out there. He's far from being presidential, but he's holding to his promises. And he said, you know what? I want it made in the U.S. I want those salaries to be paid to U.S. workers. And he's standing by everything that he's expected to from this point on. We've had some North Korea missile tests. It seems like to me we are just one economic fear away from having our market come back down and crash. I'm not saying that to scare anyone. They're just simple numbers. Simple numbers says we have a huge drop down in the near future. It doesn't make me excited, and you hear me go, I don't know how you feel comfortable when North Korea says, by the way, we just tested a ballistic missile that we feel we have nuclear capabilities that can reach the United States. We have the French presidential elections. Those have kind of taken a back burner. Don't forget there is a chance, and the Popular Party over in France looks like they may have their president, I don't remember her name, but that if she gets elected, she will also leave the European Union, which would mean the second leg of the three-legged stool, Great Britain, France, and Germany, that put the majority, 80-90% of all the mortgage-backed securities or QE funding into the European Union. If you lost France, the whole European Union is being run by Germany, and it's being funded by Germany, which is not one of the better scenarios for a stable European Union. Going through, we have overvalued U.S. markets with no substantial changes yet, just meaning the U.S. markets are overvalued. We're on the high end of our valuation points. On the S&P 500, they mirror valuation points to 2008, 2000, 87, 83, some of the big crashes that we've had. Probably tax reform is coming, but it won't be implemented into 2018. That could be a definite crushing blow to our market. Historical first quarter sell-off we are not having as of yet. Really, we've had a historical January, second best ever. We're holding pretty good in February as well. It'll be interesting to see if we do get our typical or historical first quarter sell-off. Last but not least, something that we do need to be paying attention to. This could be a positive or a negative. It depends how it is spun. With deregulation, the U.S. banks no longer have to hold those treasury bonds, which means we could see a significant sell-off on treasury bonds. Of course, if our banks are selling off treasury bonds, China will sell off theirs, and they have been doing it here recently. But you don't want to hold an asset that's in a downward moving trend. So you could see hundreds of billions of dollars of selling off of U.S. treasuries. How is that good? Well, that money has to go somewhere. Could be pushed right back into the U.S. stock market. How is that bad? Well, if there's a flood of U.S. Treasury bonds, the U.S. government cannot sell those treasuries. That's a source of income to borrow against. And with a debt ceiling coming up here in March, you might see some ridiculous type headlines and or GOP, Congress, Senate squabbles that you'll kind of chuckle at because they will be rather funny. But in real life, you really can't budget or put a budget into place if you don't have the revenue to back it up. Which means obviously you're going to hear people cry and scream and say, hey, we're going to go into a bigger deficit. Guys, I appreciate your time. This is what we're looking at. We appreciate your business. Keith, anything you want to end with today? Any last
No,
parting
you said it
comments?
perfectly. I'm glad to be here with you and be a part of Hurley Investments. It's an exciting future. So yeah, just glad to be a part of it.
I agree with you. Hey guys, there's our recap for our options expiration. You'll see a lot of possible movement in accounts today. We do have Monday off. It's a holiday, so enjoy your 3-day weekend. Pleasure being with you today, and we'll get this emailed out as quickly as possible. Keith, thanks again for being with us today, and guys, we look forward to talking to you in the near future. Bye-bye.